Welcome back to the Financial Freedom Show. My name is Rob Berger, and in today's video, I'm going to walk through in quite some detail how to get started investing for the very first time. It's a topic that many folks have asked me to put together a video on. I've received emails from folks, some comments to other videos, and that's what we're going to do today. And I'm going to do it in a somewhat different way, I think. Let me show you what's on my screen. This is a note-taking app that I use for all of my research. It's called Roam Research. And I'm actually going to be, in this video, taking notes, as you'll see on the screen, walking through how you can go from knowing nothing at all about investing to being able to invest with confidence, which for me means knowing not only what you should be doing, but why. And it's the why that I think is, frankly, maybe even more important, because if you invest for any length of time, and I've invested, in the stock market for almost 30 years, there are going to be times when, it's going to get nerve-wracking. I mean, we saw it earlier this year in 2020. Sometimes the market was down by 10% in a single day. In 08, 09, it was down by about 50%. These are frankly some of the most lucrative times to invest. But if we don't know what we're doing, and if we don't know why we're doing it, it's going to be very hard to weather those sort of stock market storms. And the reality is, particularly if you're younger, if you're going to invest over your working career and into retirement, you're going to go through periods like that over and over and over again. I mean, it won't be every year, but certainly probably every decade, and even possibly even more frequently. And so if you know what you're doing and why you're doing it, I think it puts us in the best possible position to make smart decisions even in difficult times. So the idea behind Roam Research is, when I am done today in this video, I will share with you how you can get access, and it's totally free. I'm not selling anything here. You're going to get access to my notes. You're going to be able to log in and see all of the notes that I'm about to take, including links to resources. I can embed YouTube videos in Roam Research. And so that's the reason I'm doing it this way. And in fact, I plan to add additional content to this tool that you'll have access to as well over the coming days, weeks, months, as I do more videos this way. So I want to get started. And as sort of just to begin with, when I talk about how to invest, first of all, I'm talking about, and here's our plan for today, I'm talking about long-term investing, okay? I'm not talking about day trading. I'm not talking about options trading or, buying crypto or whatever. We're talking about long-term, I'll even add something here, long-term buy and hold investing. It's what I've done for almost 30 years. It's what allowed me to start off with about $50 a month in a mutual fund. And you fast forward, I retired, in my 40s. And although I guess I then went back to work, so I've retired a couple of times. In any event, that's what this video is about. Investing terms can seem daunting. When someone says that they're really happy with their small cap value fund, well, if you don't know what that means, it can seem intimidating. Once you do know what it means, it's not intimidating at all. So a lot of what this video will be doing is, kind of putting in context some of the terminology. Now, if I mention a term and I don't define it in the video and you want help with it, just leave a question in the comments below the video, and I'll do my best to help you. Third thing is, as you've probably already guessed, this is going to be a very detailed video. This is not a 8.5 minute, 10 ways to start investing. This is no, let's roll up our sleeves and let's learn what we need to learn to invest in a smart way, not for just a day or not for a week, but for a lifetime. So this will be a detailed video. Having said that, I am going to put timestamps in the description below. As you'll see, everything we're going to talk about today falls within four main questions, and you can jump from one to the other through the timestamps in the description below if you want to move around. As I mentioned, this is Roam Research. That's what you're seeing on your screen. Again, it's a tool that I use in all of my research on investing and other things. What you're seeing now is a public version of that tool that I can give you access to. As I mentioned, I'll do that. I'll share that, how you can get access to it at the end of the video. So with that, let's get right into it. As I mentioned, there's, how to invest really comes down to 4 questions. Everything comes down to 4 questions. And let me lay them out for you now. The first one is maybe somewhat of a surprise to you, but it's what type of investment account should we open? And actually, I should probably add a potential plural here, because sometimes, and this is the case for me, you have different kinds. You open multiple types of investment accounts. But that's question 1. What type of investment account should we open? Once we know that, then the question is, what do we invest in? And here, this is mainly, again, long-term buy and hold, sort of investing for retirement or financial freedom. So in large part, we'll be discussing mutual funds, but we'll be talking about, what do we invest in? That's question 2. Question 3 is related, and that is, where do we open the investment account? That's an important question. And the third one then is, how much money do we invest? Now, that is at one level a very personal question, going to depend on your goals, your income, and so on. But there are some things to think about that I think are relevant to anyone. And so I'll touch on that briefly in that question. So those are the 4 questions that we need to tackle in order to invest, again, with confidence. Maybe I'll add that, how to invest with confidence, right? I mean, anyone can tell you go open up a Robinhood account. That's not exactly helpful. So this is what we're going to do. This is what we're going to tackle. And so, let's jump right into it. And we'll begin with the type of account. Now, here, every investment account can actually be categorized. It just falls into one of 2 categories. It's either a taxable account or it's a tax-advantaged account. I think, as you probably know, a taxable account is just sort of your ordinary basic account, not unlike your checking or savings account. What I mean by taxable is any income, any interest or dividends, or if you sell an investment at a gain, you earn what's called a capital gains. In a taxable account, it will be taxed in the year you earn it, or one of the words they use is realizing a capital gain. If you bought Apple and a year later it had gone up in value and you sold it, that would be realizing the gain from that investment. In a taxable account, they're taxable in the year you earn that income or capital gains. With tax-advantaged accounts, you actually get some tax benefits with them. And tax-advantaged accounts, for our purposes, actually fall into 2 categories. And really, just to take a step back, when you think about tax-advantaged account, it's more than just retirement accounts, right? You can have an education account that's tax-advantaged. That'd be a 529 plan, right? Or you can have a healthcare account that has a tax advantage to it. An HSA, health savings account, would be an example for that. But for our purposes, we're talking about retirement. And when it comes to retirement, you can kind of think of, there's sort of 2 ways to categorize a retirement account. The first is it part of is it an employer plan? That is a retirement plan offered by your employer, right? Or an individual plan, one you open up on your own. If I could type here, individual plan, right? So it's either tied to your employer in some way, or it's a plan, a retirement account you can open up on your own. And the second way we can categorize retirement accounts is a Roth versus traditional. Now, if these terms are new to you, don't worry, we're gonna cover them. But in deciding the best type of retirement account to invest in for retirement, those are the considerations that we have to think about. Do we go with a plan perhaps offered by our employer, if we have that option? Do we open up an individual retirement account, an IRA? Or is actually another option, both. We could open both. And, my wife and I each have both workplace retirement plans and an IRA, so you can have both. And then the question is, whatever we decide on that question, do we open up a Roth or a traditional, or you could do both as well. So those are the questions that we have to answer. And I think they're really pretty straightforward. Let's start with the employer versus individual plan, and I'll actually just call this an IRA. I think many of you are familiar with that term. It stands for individual retirement account. Sometimes it'll be individual retirement arrangement. So how do we decide, and what does this all look like? Well, let's start with an employer plan, just so we know in terms of terminology what we're talking about. Here, I'm talking about things like 401k, 403b. There's even a 457 for, I think, local government employees. I'm pretty sure that's right. I've never had a 457. And there's even the TSP, right? Thrift Savings Plan. That's for federal employees, members of the military. Thank you for your service. Even United States Postal Service members have access to the TSP, which is like a 401k, effectively is. By the way, if you're wondering what's up with all those numbers, those just reference the Internal Revenue Code that authorizes each of those types of retirement plans. The 403b, by the way, is one that, for example, a nonprofit would have, because they fall under a different provision in the Internal Revenue Code. My wife actually worked for a nonprofit and adoption agency for many years. So she had a 403b. I was at a law firm. Trust me, we were not nonprofit. So we had a 401k. But these are all employer retirement plans. And then on the individual side, you basically have the IRA. There's actually, believe it or not, many versions of the IRA, even beyond Roth versus traditional. We'll talk about that in a minute. But for our purposes, that's basically the option in IRA. And so as you can tell, and I'll use 401k just generally for the employer retirement plan, that's going to be something offered by, at your workplace by your employer. And that might be one option for you. And then the other option is you could open up your own retirement account, and that would be an IRA. And that now raises the question, well, how do we think about these two types of retirement accounts and which one is best? And to answer that question, I'm going to drop in a table here that will at least begin to answer that question. Bear with me. We'll put it here. All right, so I've put together a table, and let me make one change to it. There we go. These don't represent all of the differences between a workplace retirement account, in this case a 401k and an IRA, but I think it shows you sort of at a high level some of the key differences. The first is, as you can see in the top couple of rows, both accounts have contribution limits. You can't contribute an unlimited amount of money to these tax-advantaged accounts. So they both have contribution limits. As you can see, the 401k's limits are much, much higher than an IRA. The catch-up contribution, by the way, is available for folks like me who are 50 or older. I think the idea is, we're getting closer and closer to retirement. Maybe we have some catching up to do. So the IRS lets us throw a few more bucks into the account. Now, one of the big differences, and this is really where we get to deciding what's best for us, is the matching contribution. Many employers will match a portion of the contribution you make to their retirement plan, again, as an example, 401k. Obviously, with an IRA, there's no employer involved. You open that on your own, so there are no matching contributions. But that's a very important distinction. And in fact, it really answers the first question. If you have a workplace retirement plan that matches a portion of your contributions, you want to do everything you can to take advantage of that match. So if we were going to come down here for a minute and I'll call it decision rules. How are we going to decide? Rule number one, always get the match. So that's going to favor, I'll just call it a 401k. Again, you may have a 403b or whatever, but that's going to favor I guess I'll call it the workplace retirement account. Always get the match. Now, there are some other things, back to our table here, that I think are advantageous with a 401k, particularly for new investors. The first is we don't have to worry about where to open the account. Remember, where to open the account is one of our 4 questions. But if you're contributing to a workplace retirement account, that's one question you don't have to answer because your employer decides who's going to administer the retirement plan, and you're going to open it up wherever your employer has the plan. And of course, if you're not sure, you can talk to HR. You probably got information on it when you started at the company, but that's one decision you don't have to worry about. The other thing is that contributions to a workplace retirement account come out of your paycheck, just like your taxes do, just like maybe healthcare premiums. You don't have to actually go to the trouble of making the contribution yourself. You simply designate what percentage of your pay you want to go to your retirement account, and your employer deducts it and puts it in for you. With an IRA, not only do you have to decide where to open it, you actually have to make the contribution yourself. Now, it's not that complicated, and you can even do an automatic transfer from your checking account. You could set that up monthly or whatever. So it's not exactly difficult, but it is, a few extra steps. And so if you're just getting started, I think often the easiest thing to do is to go with a 401k or other workplace retirement account if you have that available to you. And if there are matching contributions, you're absolutely going to want to contribute at least enough to take full advantage of the match. And if you can't afford that to begin with, that's fine. Invest what you can and make that your first goal, increasing your contributions with your employer's plan until you can get the match. Now, in terms of decision rules, before we get to rule number 2, we have to, let me change this here. We have to discuss Roth versus traditional. And so here we are. With all tax-advantaged accounts, that's true not just for retirement, but for education accounts, healthcare accounts, there's a carrot and a stick. The carrot is some tax advantage that the government gives you for contributing to the account. The stick is what they basically hit you over the head with if you don't use the money in the right way. And the idea of the stick is, we'll use retirement as an example, they're giving you this tax break because they want you to save for retirement. So, for example, if you take the money out before retirement, they may penalize you. That's the stick. So, for example, with a 401k or IRA, if you take money out before you're 59 and a half, you could get hit, in addition to taxes, you could get hit with a 10% penalty. Now, there are exceptions to that rule. I'm not going to go into all those details today, but I want to make you aware of that. Carrot and stick. Carrot is a tax advantage. Stick is potential penalties if you take the money out early. And so now, what's the difference between a Roth and a traditional 401k or IRA? Well, a traditional is also known as a before-tax retirement account. What that means is you get a tax break when you make the contribution. So, for example, if you contribute $10,000 to a 401k, that money is excluded from your income tax, right? Or from your taxable income. So, for example, with a 401k, when you receive your W-2 at the end of the year, you'll see on that they have deducted your $10,000. You'll see that as on the W-2, and then in terms of your taxable income, it won't include that $10,000 that you contributed. So that's sort of the tax break you get with a traditional 401k. IRAs work the same. They're a little more complicated because depending on your income and whether you have a retirement plan at work, your deduction, your IRA contribution may or may not be deductible. Something to keep in mind. What I'm going to do at the end of this video is include in here a bunch of resources, mainly from the IRS, that you can look at if you want to kind of dive into these details. And I'll do more future videos that go into these pretty important, admittedly important concepts, but not for today's video. Now, the $10,000 in our example, it's excluded from taxable income. That's the carrot. What's the stick? As I mentioned, 10% penalty if you take out the money before you're 59 and a half, although there are some exceptions to this rule. So that's for traditional. You get a tax break when you make the contribution, but that's the good news. But if you take the money out early and there's not an exception that applies, you could get hit with a 10% penalty. And the third thing is, in retirement, distributions are taxed as ordinary income. So eventually the IRS, as you might imagine, eventually they get their money. Now, with a traditional retirement account, depending on your age, it could be decades before they get their money. So during that time, you get to keep the money in your account and it gets to earn interest and dividends and capital appreciation. So that's the benefit. But eventually, when you do take the money out, you do have to pay taxes on it. It's treated as ordinary income. Now, you can think of a Roth as after tax, and it kind of works in reverse. If you contribute $10,000 to a Roth 401k, again, I'm just using this as an example, you get no tax break. No tax break at all. In fact, that $10,000 you pay taxes on all your income, and then they put $10,000 into the 401k. So there's no tax break, which may make you wonder, well, where's the carrot? Well, the carrot in the case of a Roth comes when you retire, because when you retire, you can take out the money or in the distributions. They're tax-free. Now that's a pretty good benefit, and let me show you as an example how that might work. So this is just a spreadsheet. I did a quick formula. Future value, I assumed you're contributing in this case, well, we'll make it 10,000 since that's what we used in our example. 10,000 a year for 40 years at 8%, you'd have $2.6 million. By the way, if that number surprises you, welcome to the wonderful world of compounding. Now, your contributions would have been 400,000. Your gains, almost 2.2 million. If this is a Roth account, that's all tax-free. Not only the $400,000 in contributions, which was with after-tax money. Of course, that you would expect that to be tax-free. You already paid taxes on it. But even this almost $2.2 million is totally tax-free. Now, if this were a traditional 401k, all of this, the entire nearly 2.6 million would be taxable. It gets taxed as you take it out in retirement. It gets taxed as ordinary income. So that's the downside of a traditional 401k, but those contributions that you made over the past 40 years in our example would have been deductible, if you will, would have been excluded from ordinary income during each year when you made the contribution. So that's the basic difference between traditional or before tax retirement accounts and Roth or after-tax retirement accounts. Now, again, there are countless nuances, not only between these two, but also, frankly, between a Roth 401k and a Roth IRA. Kind of like lightning and lightning bugs. They may sound similar, but they ain't. There are some differences. I'll leave resources here at the end of the video in these notes for you. But for our purposes, I think what we've got here is enough to work with. And it gets us to the decision rule number 2. So remember, number 1 is always get the match. Number 2 is max out a Roth IRA. Now, why do I say that? The Roth, whether it's a 401k or IRA, is best for folks who are in the lower income tax brackets. And the reason is, with a traditional retirement account, yes, the money is excluded from your income, which can be a great deal if you're in the top tax bracket, particularly if you live in a state like, say, New York or California, which also has very high taxes, then you might want the traditional retirement account because the tax break is going to be pretty significant. But I think for most people, and particularly younger folks that are just starting out, most folks don't start out in the top tax brackets. And so in that case, I personally think the Roth is the better way to go. So the way I would approach this, rule number one, contribute to the workplace retirement account. For most people, I think it would be a Roth 401k. Contribute to that at least enough to get the match. Again, that's probably around 6% of your income for most employers with a matching contribution. Once you're able to do that, begin working on maxing out a Roth IRA. Once you've done that, what I would do, and this is rule number 3, is I would go back and max out the 401k or other workplace retirement account. Remember, in step 1, we just contributed enough to get the full match. Rule 2, Roth IRA. Rule 3, go back and max out the 401k. And then rule number 4 is by and large, you're left with a taxable account. There are other nuances. I haven't mentioned health savings accounts, which generally are for healthcare expenses, but they can also be a good retirement vehicle as well. I'll cover that in another video. I think again, at a very high level, I think this gives you enough to get started, to think through these issues and make what will be the best decision for you. So with that, I'm going to stop talking for a second. Give me a minute. I'm going to add a bunch of resources to this section of our outline. Okay, I'm back. So you'll see a number of resources here. Some of them, I really could spend some time with. For example, here's a Roth comparison chart from the IRS that compares Roth 401k, a Roth IRA, and then a pre-tax, or what we've been calling a traditional 401k. One thing to note as an example, remember I mentioned that a Roth 401k and a Roth IRA, like lightning and lightning bugs, they may sound similar, but they ain't. Well, there are some similarities. They're both after-tax retirement plans. But for example, notice the income limits. With a Roth 401k, you could make $1 trillion a year and still contribute to a Roth 401k. But you couldn't open a Roth IRA. It's possible to make too much money, and you get disqualified from opening and contributing to a Roth IRA. So that's one thing to note. Another thing to note is that there's such a thing as what are called required minimum distributions, RMDs. They're particularly relevant to traditional retirement accounts. And basically, when you get to a certain age in your early 70s, they sort of force you to start taking out money from traditional retirement accounts. And the reason is because Uncle Sam wants his money. He wants his taxes. And so eventually you have to. It used to be 70 and a half. They've bumped it up to 72. There's actually legislation pending in Congress that would bump that up to 75. But in any event, with a Roth IRA, there are no required minimum distributions. Because it's tax-free, right? So they don't force you to take it out because Uncle Sam doesn't care. He ain't going to get any money. But believe it or not, with a Roth 401k, and a lot of people don't realize this, there really are required minimum distributions for a Roth 401k. Now, as a practical matter, don't tell the IRS I'm telling you this. You could roll over your Roth 401k into a Roth IRA, but that's for another video. All right, so that's one resource that I've put in here. Obviously, there are a number of others. We've got a 401k resource guide from the IRS, which is really good. A really good article here from the IRS comparing traditional IRAs and Roth IRAs. So a lot of good stuff. And I will continue to update this resource list in these notes that you'll have access to as I come across new resources. So that's really the first question. What type of investment account should we open? Now, the next question, which really gets to the heart of what do we invest in? So we've opened up our account or accounts. Maybe you've opened up a 401k and an IRA and a taxable account for that matter. What do we invest in? So for this, I think we need to start with some terminology. We need to make sure we understand some basic investing terms. And let's start with stocks. Stocks are simply ownership of a company. right? If you buy a share of Apple, you are a part owner of Apple. Tim Cook works for you. Now, you're a minority shareholder. I doubt Tim will take your phone call, but you are an owner of Apple. And as an owner, you're entitled to your share of dividends, which are a portion of the profits that the board of directors of a company decides to pay out to shareholders. Apple pays a dividend. And so when it does, you're entitled to your share. And of course, if the company does well and the stock price goes up, that belongs to you, right? So that's sort of some of the benefits of ownership. Now, when we talk about stocks, you may hear other terms like equity or equities. Someone says, the equities are doing well. They're talking about stocks generally. Sometimes you'll hear the term shares, same kind of idea. So stocks, that's the first term. The second one we need to know is bond, and this is just debt. If you buy a bond, you're effectively becoming a lender. You're lending money to someone. So, for example, the U.S. government, it issues bonds and investors invest in them. You're just lending money to the U.S. government. Corporations like Apple can issue bonds, and if you invest in them, you're letting Apple borrow some of your money. And you can even lend money to local governments, municipalities. You'll often hear the term munis, short for municipality. But all of these are forms of debt. And as a bondholder, you're not an owner, right? If you buy a bond issued by Apple, you don't own any of Apple, but you have a contractual right to receive interest on the amount of that bond. And then, of course, to get the return of your money when the bond matures. So we have stocks and we have bonds. Now, the next key term would be mutual funds. Now, maybe the easiest way to explain mutual funds is to describe the problem that mutual funds are designed to solve. So imagine all we had were stocks and bonds and we wanted to invest. What would we do? Well, we would have to evaluate companies and decide which companies to invest in and how much to invest in each one. Same thing with bonds. We'd have to evaluate the companies or governments or local municipalities that are going to issue debt, decide which bonds to buy. So you can imagine, one, it takes some skill that you and I may not have. And it would require a great deal of time to do all this analysis and research. And then once we did all of this, it wouldn't end. We'd have to constantly be monitoring all the companies, all the governments, looking at new opportunities. It's a lot of work, right? So the idea of mutual funds came along, and the thought was, why don't we get a fund that invests in stocks, a bunch of different companies, or bonds, or a combination of both. And the mutual fund will do all of that. And as an investor, all we have to do is buy shares of the mutual fund. So instead of buying shares of stocks, or rather than buying bonds, we'll buy shares of the mutual fund. And the mutual fund will go through all the trouble of figuring out what to invest in, whether it's stocks or bonds or both. And so that was the idea behind mutual funds. And so we could just describe this as it's a security, just like a stock or bond is, that itself invests in many stocks, bonds, or both. I don't know if that's an official definition, but it's close enough. Now, we need to look at two more things before we really get into what we want to invest in. And that is, among mutual funds, there are two types. There are what are called actively managed mutual funds and index mutual funds. So what's the difference? Well, it comes down to how the mutual fund picks the stocks and bonds that it's going to invest in. So one way would be to go out and hire some really smart people with fancy degrees and have them do all the things we don't have time to do, right? Evaluate the stocks, evaluate the companies, evaluate the governments, and decide what stocks and bonds a given mutual fund should invest in. So that's one approach, and that would be an actively managed mutual fund. And the idea is it's actively managed. People are actively evaluating what to invest in. Now, if you're new to all this, you might be thinking, Rob, yeah, that makes perfect sense. You're telling me there's another option? What's the other option? Would they hire trained monkeys to make this decision? Well, if they did, actually, it might outperform some actively managed mutual funds. No, the other alternative is an index mutual fund. It doesn't have to go out and hire all these smart people because all it does is track an index. And to give you an idea of what an index is, we'll use an example and we'll look at the S&P 500. So you've probably heard of the S&P 500, but it's an index that simply tracks the performance of 500 of the largest US companies, right? And we could actually pop over to Chrome and we could look at go to Google and look up the S&P 500 index, and we could actually look at some of the companies that are in the index. Go to a fact sheet here, see if it shows us some of them. Oh, it's going to download it. Now let's do this. S&P 500 index, companies. What are the companies? Here we go. So we can see right away, Apple's one of them, Microsoft, Amazon, Facebook, and there are roughly, 500. Actually, Tesla was just recently announced that they're going to be added to the S&P 500 in December. I still haven't decided if that's a good thing or a bad thing. But in any event, the point is, index mutual funds simply track an index. All they need is a computer program. As changes occur in the given index, they make adjustments to what the fund invests in. And there are many, many different kinds of indexes. There's some for small companies, middle-sized companies, large companies. There's an index that tracks pretty much all U.S. companies, not just the 500 largest. There are index funds that track foreign companies, companies located in emerging markets, that is, countries with less developed economies. So, and of course, there are bond index funds as well. So now the question becomes, great, I know, Rob, appreciate it. You appreciate all this information. So what? What's the difference? How do I decide? What we know over time is that for a large majority of index funds outperform most actively managed mutual funds over the long period of time. And that may seem counterintuitive because you think, wait a minute, the actively managed funds have all these smart people. They do. The problem is they're more expensive, right? So if you think about mutual funds, they have what's called, let me put it down here, an expense ratio. So for an actively managed fund, let's say an average expense ratio is somewhere around 1%. Now that may not seem like much, but it's actually quite a lot. In fact, if we go back to our spreadsheet, right, let me copy this over here. Remember, we assumed an 8% return, right? Well, what would happen if we had an 8% return, but we had to give 1% to the actively managed fund because that was the expense ratio? So what would happen if we go to 7%? Well, we just lost what? Over $500,000, over 600, almost $600,000 from just that one small, seemingly insignificant 1% fee. Yeah, fees matter. They matter a lot. And so if we go back here, well, what about an index fund? Well, the fees vary. Some are actually free. Fidelity has some index funds. They don't charge any expense ratio. But I would say for most funds, we'll call it from 0.0% to roughly 0.2%, give or take. This would be, they would describe this, by the way, as 20 basis points. 1% would be 100 basis points. So you could call this 1% or 100 basis points. This would be described as 20 basis points, but relatively inexpensive. And so it turns out that actively managed funds have a really hard time beating index funds enough to make up for their costs. And what makes it even more challenging from an investing perspective is, while there could be some actively managed funds out there that over the next, 20, 30, 40 years do outperform the index, we have no idea which ones they are, right? I mean, we can't go back to the future, so to speak, and see who's going to be the winner, right? We don't know. What's even worse is, even if we got lucky enough to pick the winner, but we won't know ahead of time, right? there are probably going to be years when it significantly underperforms the index, even if after, say, 40 years, it turns out to be a winner. Are we going to stick with that actively managed fund when for 2 or 3 or 4 years, it's really not doing so well? So the long story short is that I have almost exclusively invested in index mutual funds. There have been a few exceptions here and there, but I find them to be the best way for investors to invest. They're simple, they're easy to understand. You never have to worry about whether the fund management is having a bad year or just made some horrible mistake, because all they're doing is tracking the index. Now, before we leave this debate, let me just leave you with a quote from Warren Buffett, arguably the greatest investor of all time. He's the chairman of Berkshire Hathaway. Here's what he had to say. He said, most investors, both institutional and individual, will find that the best way to own stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net result after fees and expenses delivered by the great majority of investment professionals. What I find fascinating about this quote is he's saying not just individuals, but even institutions like large university endowments. Even institutional investors would be better off with low-cost index funds. All right, now that we know what a stock is, what a bond is, what a mutual fund is, we understand the difference between actively managed funds and index funds, we know what an expense ratio is, and we know what Warren Buffett thinks about all of this. It's time to actually begin putting together what would be called in the business, let me see if I can get this to work, an asset allocation plan. You might also think of this as maybe an investment plan. And the easiest way to think about this, those terms may be new to you, may sound fancy, it's really not. It's just a recipe, right? It's an investment recipe. So if you think about a cooking recipe, you need to know what? You need to know the ingredients, and importantly, you need to know how much of each ingredient, right? So like if it calls for a cup of sugar and a pinch of salt, what you don't want to do is put in a cup of salt and a pinch of sugar, right? That's not going to work. So with an asset allocation plan, it's our investment recipe. We want to know what we're going to put in our plan, what are the ingredients, and how much of each. So at a high level, we could say the two primary ingredients are stocks and bonds. Yeah, you might add some cash as a third ingredient, but that's not altogether helpful. It's like saying I'm going to cook a meal and what are my ingredients? They're going to be protein, carbs, and fat, right? I mean, it's at a high level, I suppose that's true, but what kind of proteins? What kind of stocks, right? What kind of carbohydrates? Well, what kind of bonds? Now, the good news is we can come up with a really easy approach to this, and I'll do that. But before we get there, let me just give you a couple of basics. So when we talk about stocks, we think, well, okay, what kinds of stocks are there? What kind of stock mutual funds are out there? Well, you can divide stocks in a number of ways, or categorize them, if you will. One is by location, right? So you could have U.S. companies. And that's, for example, we mentioned the S&P 500 index. That's exactly what that is. It's an index of companies. Many do business all around the world, like Apple, for example, but they're headquartered in the United States, right? You could have companies in Europe. Sometimes they'll have mutual funds that cover what they call developed markets, which would be foreign countries, at least from the U.S. perspective, that have mature economies. You could have, they call them emerging markets. These would be countries with less developed economies. So you can divide stocks or stock mutual funds based on the location of the company. You can also divide it by size, right? So you have large companies. Again, Apple's an example of a large company. You could have mid-sized companies, and they call them mid-caps for short. Cap is short for capitalization. It's just a fancy way of saying how much is the company worth. So we can actually change this to large cap, fine, mid-cap, good. They have small cap companies, and they have, by the way, mutual funds that cover each of these categories. They even have, you might even find a micro cap mutual fund that invests in really, really small companies. Now, these are public, So keep in mind that a really small public company might be worth a couple of billion. Not exactly small for you and me, but for a public company, when you consider that now the big companies, the biggest, are worth over a trillion, right? It's kind of hard to imagine. So you have size, you have location, you have size. There are a couple of other ways, one in particular that you can sort of categorize stocks, and it's based on valuation. I don't want to go into a lot of detail here, but just some terms to know. There's growth, there's value, and there's a blend of the two. Growth would be just a company that's growing, say, revenues, profits, and maybe cash flow faster than average, or than the average company, right? An example of this might be Amazon, maybe Tesla. Those would be growth companies. And you might say, well, that sounds pretty good. Why would I invest in anything else? Well, these tend to be expensive relative to their revenue. And sort of value is kind of the opposite. These tend to be more older companies, well established, and cheaper relative to their earnings. So a good example of that might be banks. Many banks are value stocks. Utilities often value stocks. Actually, at one point when I was first investing in Apple, I think this was in 2013, I first bought shares of Apple. It was a value company at the time. It's now, I think, considered a growth. Anyway, blend is a combination of both growth and value. So you have mutual funds that say, yeah, I'm not going to bet on whether growth or value is the better way to go. I'm just going to, cover my bases, do both. And a good example of a blend mutual fund is one that tracks the S&P 500 index. It's a blend. All right. So that's how we can think about stocks and the different sort of ingredients that can come in the form of stocks, if we want to use our recipe analogy. And then we can do the same thing with bonds, right? There's different ways to categorize bonds. So one would be by the lender, right? So for example, you have funds that invest in just U.S. government bonds. That's it, right? Or some that invest in just corporate bonds. And there's some that invest in just munis, right? Remember, that's municipal bonds, local bonds. So who the and I said lender, I meant who the borrower is. And in the Wall Street jargon, they wouldn't call them a borrower, they would call them an issuer, because they issue the bond, but same concept. So who the issuer is, borrower is one. Credit risk. Are they a good credit risk or a bad credit risk? Do we have confidence they're going to pay us our money, our interest on time, and then when the bond matures, give us our money back, right? So probably the strongest credit risk, again, would be U.S. government bonds. And that's in part because the Treasury can just print money and pay us back if they want to. Certain, like I'll call it investment grade corporate bonds, are considered pretty safe. Again, if Apple issued a bond, they've got so much cash and cash flow, it'd be a pretty safe bond. And then you have some that aren't as safe, and they call those high yield bonds. And these are issued by corporations that maybe aren't quite as strong as Apple. And they have different ways, ratings, companies that rate companies and determine whether they're a high yield or not. Other words for this would be, you may have heard of junk bond, right? Or they, below investment grade kind of thing. And you might say, well, why would I ever want to risk my money this way? Well, you don't have to. Again, everything's a carrot and a stick, right? So the carrot is you get higher interest rates or yields than you would, say, with a U.S. government bond or an investment grade bond. That's the carrot, the stick, so to speak. Yeah, they're riskier. So credit risk is another way to sort of categorize bonds. The third one, they call it interest rate risk. And by the way, who issues it and credit risk kind of in a way go together. But interest rate risk deals with the risk that interest rates will go up while you're holding your bond, and that will lower the value of the bond. That can be a little confusing, but think of it this way. Let's say you buy a U.S. government bond that's paying 1%. It's a 10-year bond. And let's just imagine the next month interest rates go sky high, and now you can buy a 10-year bond for 3%. Well, you'd much prefer that 3%, but you're stuck for 10 years with a 1% bond. Now, you could just say, well, that's just the way it is. I'm stuck with it. And you're going to effectively be out that extra 2%. You won't actually lose money in the sense that someone will come into your bond account and take money out, but you'll be earning less than you could have. You could decide to sell it so that you could go out and buy one of these new fancy 3% bonds. But of course, who's going to want to buy your 1% bond when they can go buy a new one and get 3%? So what would you have to do? Well, you'd have to sell your bond at a discount to make up that difference. And thus, that's why when yields or rates go up, existing bonds, the value of them go down. All right, so you have interest rate risk. And so I'm going to stop there with the lesson on asset allocation. We could spend 100 videos on asset allocation, and I will do more in the future. But I wanted to give you a sense so that when you see these terms and concepts, you kind of understand them, at least at a high level. The good news is when we actually go about coming up with our plan, we can have all of this in the back of our mind, but we don't have to worry about it. And what I'm going to do is give you two, I'll call them model portfolios. As you'll see, one of them is so simple, it's almost not worth calling it a model portfolio, but that's what I'm going to do. And we can close up all of this. We don't need to worry about those details. And in fact, can just close that up. All right, so I'm going to give you two ways that I think are really good ways to get started investing. And the nice thing about it is they're simple to do. And then, of course, along your journey towards financial freedom, you can continue to learn more, educate yourself, read, and you'll come to your own sort of sense of how you want to invest. And it'll be perfectly fine if you move away from these models, right? So, but I think these are good approaches. And the first one is what's called a target date retirement fund. And what this does is it says, look, you don't have to worry about an asset allocation plan. If you just invest in this one mutual fund, and I'll show you some examples in a minute, we'll take the money you invest and we'll divide it among all of these different asset classes for you. We'll invest some of it in US stocks, international stocks, government bonds, corporate bonds, maybe even some international bonds. We'll do the work for you. It's almost like, if you want to take the recipe analogy probably further than I should, it'd be like going out to eat. You don't have to cook. You can tell them what you want and they cook for you. So what do these look like? Well, let me drop in a link here. And I'm going to use Vanguard as an example. We'll use this Vanguard account as an example of a target date fund. So here it is. Pull it up on the screen. Now you'll notice this is the Vanguard Target Retirement 2050 Fund. In target date retirement funds, you'll always see a year as part of the fund, and it's there to make it easier for you to pick the right one. And so the idea here is this would be ideal for someone who wants to retire in the year 2050, so 30 years from now. They have, as you might imagine, the 2055 fund, the 2060 fund, the 2030 fund. They have a 2015 fund for folks that have already retired. You can see, if we look at the portfolio, what do they do with your money when you invest in this fund? Well, what Vanguard does is they divide it up into these four Vanguard funds. So they put about 54% in the Vanguard Total Stock Market Index Fund. So that's a fund that invests in basically all of the U.S. public companies. They put 36% in an international stock index fund. They put, 6.5% in a total bond market fund, and 3% in an international bond fund. They do that for you. And the nice thing is, as prices change and these investments go up in value or down in value, they'll do what's called rebalance your investments for you to bring them back in line with the percentages here that they want for this particular fund. The other thing that's nice is, as you get closer to that 2050 mark, they're going to start changing this allocation more towards bonds to make it a little less volatile, which is sort of a common approach to investing. You don't have to do that on your own. So this is really a sort of set it and forget it investment. You might say, well, Rob, why didn't you just tell me this to begin with, and you could have saved all that nonsense about asset allocation? Remember, We don't want to just invest, we want to invest with confidence, which means we want to know what we're doing and why we're doing it. And so some of that sort of background information can help you understand what's going on in this mutual fund. Now, I think just about every workplace retirement account will have some form of a target date retirement fund available to you. And I want to show you something on that out of my own actual 401k. All right, what we're looking at here is my 401k at Forbes, and this lists all of my investment options. These are not the actual investments that I have. These are all the choices I have inside my 401k. Can you look at it and figure out which of these mutual funds would be a target date retirement fund? Well, the giveaway is that there's a calendar year in the fund name, right? So we come down here, we can see here's the 2005, 10, 15, 20, all the way up to 2065. Here's the Fidelity, that's what FID stands for. They call their target date retirement funds Fidelity Freedom Funds. It's just a name they've given them. If we click on the 2050 fund, we see this data. And if you're new to this, this can look overwhelming. I've done an entire series on Morningstar. You can see this data comes from Morningstar. You can see that right here. And trust me, this is extremely easy to understand. I'm not going to go through it here. If you want to know more about Morningstar and how it works, I'll leave a link to the video in the description below. I have a series of 5 videos that walk through Morningstar. But the thing I want to point out is the expense ratio. Remember, we talked about expense ratios. They're important. This one is 65 basis points, right? In the world of mutual funds, that's not the worst expense ratio. I mean, there's certainly ratios that go well above 1%, some that even go above 2%. Still, that's higher than I want to pay. Now, if I wanted to invest in a target date retirement fund, I would invest in this fund, but I think once I left my employer, I would probably roll this over either to my new employer's 401k if I could and I liked their investment options, or I would roll it into an IRA for cheaper options. And if we go back to Vanguard and we look at fees and minimums, you'll see their expense ratio is just 15 basis points. That's 0.5% less than Fidelity's. And if we go back to the spreadsheet we were looking at, remember this was 8% return assumption. Here we looked at 7%, but what if we just bump it up to 7.5? Not bad, we've gone up some, but you can see we're still, goodness, 2, 3, 4, 5, about $300,000 off, all because of a 0.5% difference in expense ratio. So now this is over a long period of time, but this is an easy way to improve your wealth, is to keep your expenses down. And I don't mean to pick on Fidelity. They offer a lot of really good index funds, including many that are actually free. So Fidelity has some great funds. It's just that their particular target date retirement funds are not great, in my opinion. Vanguard's are fantastic. There are others that are good. But the real takeaway is that as good as target date retirement funds are, please be mindful of the expense ratio. You got to check that out. And again, if you want to understand how to find the expense ratio, I just showed you inside of both the Vanguard website and Fidelity's. But again, the Morningstar series will walk through all of this. It's very easy to do. So with that caveat, our first approach, target date retirement fund, very easy to do. You just pick one fund and you're done. That's simple. Now, there is, I suppose, one potential downside to target date retirement funds, and that is you don't have control over the allocation inside the fund. You have some control, right? Because you picked the 2050 fund. Just because you might retire in 2050 doesn't mean you actually have to pick that fund. You could pick, I don't know, the 2040 fund. If you liked that allocation a little better, there's no target date retirement fund police. They're going to come by and say, wait a minute, you can't pick the 2040 fund. I heard you're retiring in 2050. That's just a name, right? So you could pick a different one. But beyond that, you're sort of stuck with the allocation, the asset allocation plan, the recipe, if you will, that they have chosen for that fund. Again, I think for most folks, that's probably fine. But if you want a little more control, but you don't want to get crazy complexity in all of this, the second model portfolio that I want to show you is called simply the 3-fund portfolio. So a three-fund portfolio is really simple. As the name suggests, we can create a well-diversified portfolio with just three index mutual funds. And the three funds cover US stocks, international stocks, excuse me, and then typically US bonds. That's it. Now, we still have to decide which specific mutual funds, and we also have to decide how much we put in each of them. So let's change this a bit. And now what we're going to do is I'm going to actually create this for you, and we'll start with Vanguard. So what funds might we use if we had access to Vanguard? Well, we can go back here. We can actually look at the portfolio for the Vanguard Target Retirement 2050 Fund, right? We've got the Total Stock Market Index Fund. We've got the Total International Stock Index Fund. So those would both cover US and international. Now they use a Vanguard Total Bond Market 2 index fund. We might have something slightly different for that one. But let's go ahead and we're just going to drop this one in for our US stocks. And we'll grab this one for our international stocks, right? And then for the bond fund, we can actually go here, Vanguard Mutual Funds, get a complete portfolio in one fund. We've talked about that one. What we can also do is just, let's see, do it by asset class. And you can see there's money market funds, US bond funds, and we can find down here, Total Bond Market Index Admiral Shares. So that's the fund we want. And I'm even going to copy the ticker here. So there's the ticker. We can get the ticker. The ticker, by the way, is just, in the case of mutual funds, typically 5 letters, and it's just a unique series of letters that identifies the fund. So for example, if we actually took this ticker and we Googled it, it actually brings up the fund. By the way, occasionally, depending on what the ticker symbol is, you might get some weird results if the ticker symbol just happens to be a series of letters that matches some other kind of thing other than a mutual fund. But more often than not, you get the mutual fund. And in fact, the other thing we could do is search for the name of the fund, and it will likely give us the ticker. There it is, VTSMX. So we can add that in. That's the first one. And then we can search this one. And I'm showing you this so that you can do this on your own. I could have just done this ahead of time and stuck it in the video. But my goal here is really so that you can do this on your own with whatever investments you're trying to analyze. And so right there we have, whoops, a wonderful portfolio, very diverse. But by the way, between these two funds, you're looking at thousands and thousands of companies. So you can't determine the diversity of a portfolio simply based on the number of mutual funds. In fact, as we saw up here with the Target Date Retirement Fund, a single fund is going to have thousands of companies, both U.S. and foreign, and thousands of bonds. I mean, it's incredibly diverse, and this 3-fund option is incredibly diverse. Now, we can go through, right? We could also create the same kind of 3-fund portfolio with Fidelity. And since we've got my own Fidelity 401k pulled up with its investment options, let's just walk through this very, very quickly and create our 3-fund portfolio. Now here, you have to make sure we know what the funds are, and sometimes it can be a little tricky, but we can tell this one's an S&P 500 index fund. Again, FID is just Fidelity, pretty obvious from the name. The FID Extended Market Index Fund, let's take a look at that one. If we click it, we'll get this Morningstar data, right? And down here it tells us, seeks to provide investment results that correspond to the total return stocks of mid to small capitalization United States companies. Well, mid and small are great, but this would, if in a 3-fund portfolio, this would exclude large companies. So we don't really want that. that wouldn't be the best option. And frankly, the S&P 500 index fund is probably good. There's a choice between an S&P 500 index and a total stock market index that covers everything. I don't personally have a strong opinion on which is best. If you look at their returns over time, they're pretty comparable. So we could go with this as our US stock fund. And we'll just copy it right here. Let's try that again. So there's our US fund. Now for international, again, we have to kind of look through the funds. Here's the Fidelity International Index Fund. Let's see what that one's about. So here we can see, seeks to provide investment results that correspond to the total return of foreign stocks. It's perfect. By the way, really cheap. That's just 3.5 basis points. So a really good low-cost fund. Now we just need a bond fund. So we might find this down here. Here we go, Fidelity US Bond Index. That's probably going to be perfect. Seeks to provide investment results that correspond, to debt securities in the Bloomberg Barclays US Aggregate Bond Index Fund. Check the expense ratio, really cheap. That's even cheaper. It's unbelievable how inexpensive some of these funds have become. So we're done. We've got our third fund. Now, as great as that is, you may, particularly with a 401k, not have access to Vanguard and Fidelity. You may have some other workplace retirement plan administrator that doesn't give you access to those kinds of funds. So what do you do? So I'm going to give you a resource that kind of maps out what we just did, but across a number of different mutual fund companies. Here's the resource. And it's a link to the Bogleheads, which is a name based on the founder of Vanguard, Jack Bogle, who passed away not long ago. But it's sort of a reference to him, and he's sort of many consider him sort of in his company, sort of the father of index funds. The Bogleheads group is just a wealth of information. I highly recommend it. If we go to this link, it walks through the 3-fund portfolio, what we've basically talked about. But what I want to show you is when you get down here, they show you 3-fund portfolios using Schwab, Dreyfus, of course, Fidelity. And by the way, they use slightly different funds for Fidelity than what I did. Why? Because I was inside my 401k and I didn't have access to some of these funds. But that's okay. You'll notice if it has a 0 in it, that means it has 0 expense ratio. So phenomenal funds. Northern, T. Rowe Price, Thrift Savings Plan. You folks that work for the U.S. government can easily implement a 3-fund portfolio, not a problem. They show you the funds there to use and others. Of course, they have Vanguard. One thing I'll say, they use ETFs here. An ETF is very similar to a mutual fund, except that it trades like a stock. I don't want to get into the details between the two. When it comes to index funds like Vanguard, frankly, it doesn't matter which one you choose. My view is for long-term investors, there's really no need to buy ETFs. But if you look at what they invest in and the cost, at least in the case of Vanguard, they're identical. But that's what an ETF is, in case you're wondering. But in any event, this is a wonderful resource that probably covers the mutual funds available to you in your 401k or other workplace retirement account. But if it doesn't, I've walked through how to do it. Obviously, if you have any questions about this, leave the questions in the comments below. I will address them. And it's that simple. We've created a model portfolio in 2 different ways. Both are extremely easy. Are there other recipes? Of course there are. And over time, as you learn more about asset allocation, you may choose something that may be a little more complicated. For example, Some might add in small cap stocks or small cap value stocks. Some add in REITs, which invest in real estate. Some add in emerging markets. All good options, and many of the things I do, and I'll cover that in more detail in a series on asset allocation. But what you see here is a wonderful way, I think, to get started investing. And really, you could stick with this approach for a lifetime, in my view. So once you know what mutual funds you're going to use, we now have to look at the actual allocation in a 3-fund portfolio. In other words, what percentage are we going to put in each of these funds? Let me begin by saying there's no single one right answer. What we do know, though, is that we want more in stocks than we do in bonds. Why? Over the long term, stocks return a much higher, they have a much higher return. If you think long term, stocks generally are 10% or more, bonds roughly around 5%. And so we want to maximize our returns as much as we can, and that's why we put more in stocks. Now, one could say, well, why not just put 100% in stocks if they do so much better? And the answer is sort of two answers to that. One is, yes, stocks in the long term have a higher return, but they're also much more volatile. We saw that earlier this year in 2020 when stocks plummeted. Just in a single day, they fell 10%, I think at least twice. So pretty scary, right? Bonds tend to be a lot more stable. The second reason, though, is that actually over long periods of time, think a decade or more, portfolios with a little bit of bonds in them can actually outperform a 100% stock portfolio. But I think the main reason to put some amount of bonds in your portfolio is it gives it some stability. It takes out a little of the volatility. Now, that still raises the question, well, how much should go in stocks? How much should go in bonds? In my view, for long-term investors, the amount of stock should be somewhere in the 80 to 90% range. That's my own personal view. One approach to it, though, is to actually look at the target date retirement fund that we were looking at, and Vanguard as an example. You could just follow its portfolio, right? And so looking at the 2050 fund, we can see that they have roughly 10%, just like we talked about, in bonds. Now they have it split between two bond funds. We're only going to use one, but roughly 10%. They have about 50 to 55% in U.S. stocks and about 35% in international stocks. Perfectly fine approach. So we could come back and we could say, all right, for this one, we're going to have 55%. And for this one, we're going to have 35%. And that leaves us with 10% for bonds. Now, I want to stress, these numbers aren't written in stone. You know, if you wanted 50% in U.S. stocks and 40% in international, perfectly fine. If you said, no, I want 20% in bonds and therefore lower the U.S. and international stock funds accordingly, that's okay too. This is not an exact science. There's a lot of right answers, but you want to avoid the wrong answer. So if you had 80% in bonds and 20% in stocks for a long-term investor, I think that would be a problem. But here, I think this would be a perfectly fine approach, following effectively what Vanguard does for its 2050 fund as an example. And again, as you learn more, you might refine this to your own personal preferences, but I think this would be a perfectly great long-term retirement portfolio. All right, so with that, we need to move on. The next question is, all right, we've got we know what kind of accounts we want to open up. We know what we're going to invest in. Now we just got to figure out where are we going to actually invest. And so we'll come to the third question. And I think this is a really easy question. So first of all, if you have a workplace retirement account, like a 401k or a TSP or whatever, then skip this question, right? I mean, your employer decides where they're going to have their 401k or TSP or 403b. You just sign up through them. You don't decide, right? So that's easy. But what about an IRA or a taxable account? And here I think we have sort of at a high level, four options. One is a mutual fund company, right? And we've talked about two of those, Vanguard, Fidelity, right? That's one option. We could use what's called a robo advisor. Examples would be Betterment and Wealthfront. And I haven't talked a lot about robo-advisors. I put them in here mainly just so you're aware that they exist and what they are, but they kind of work like target date retirement funds in the sense that you contribute your money to your account at, say, Betterment, and it divides your money up across different asset classes. Again, US stocks, international stocks, small caps, REITs, emerging markets. The difference is you can refine it more, right? So with the target date retirement fund, once you pick your whatever 2050 fund, you're stuck with that allocation and it changes over time as you age. With Betterment, you can actually refine it and say, no, I want this amount in this fund and this amount in that fund, and it doesn't automatically change over time. So again, it gives you some more control. I guess that might be a good thing, but it forces you to answer some questions that at least right now you may not be comfortable answering. These services do help you with that. The other thing is there's an added fee, and the added fee generally I would say is around 25 basis points. Now we can go back and we can look at our spreadsheet, and we can increase this from 7.5 to 7.75 to reflect that 25 basis point fee. The number comes up, but we're still talking 150 grand over a lifetime of investing. I don't think that rules out robo-advisors. I'm just trying to stress that every basis point matters. So that's an option, robo-advisor. You could open your account with sort of a traditional broker. Think TD Ameritrade, for example. And you can invest in mutual funds and ETFs as well as stocks with a broker. And the fourth type is what I'll call an investing app. Robinhood, I'm sure you've heard of, is a good example. M1 Finance is another. And so that's an option, right? Now, I've put them in the order, my own probably personal preference. I think the starting point should be a mutual fund company. If you know you're going to buy Fidelity funds, just open it with Fidelity. Same thing with Vanguard or Schwab or wherever. You can invest in other things. You're not stuck investing just in Vanguard or Fidelity products. I own stock of individual companies through my Vanguard account. And through my Fidelity 401k, I own Vanguard fund. So you can pretty much buy anything you want there. They are brokers as well. So to me, that makes the most sense. The one caveat is that with most mutual funds, there is a minimum amount you have to invest. At Vanguard, it's typically either $1,000 or $3,000. So you do have to bear that in mind, and that may require you to save up some money before you get started. But other companies, Fidelity has different minimums. You might be able to find lower minimums than that, but I do want to warn you about that. If for some reason a mutual fund company wasn't just what you wanted to do, I do think robo-advisors are reasonable choices. Personally, I'm not a fan of the extra 25 basis points, but they do give you a lot of tools to help you with managing the investments. And they're pretty slick, honestly, with the reporting tools that they have. And so it is an option. I put brokers third, not for any particular reason. Maybe they could have even been second. I would say between robo-advisors and brokers, they're probably more tied. But again, with a broker like TD Ameritrade, you can invest in pretty much anything. So it's a perfectly acceptable option or reasonable option. The last one, though, I feel strongly about. I would not pick an investing app. I think Robinhood particularly is not great for investors. And I know that certainly among YouTube folks, I'm probably in the minority, but I think they're designed to encourage active trading. They're designed to encourage options trading, investing in crypto and commodities. And I think basically those are all good ways to not grow your wealth. They may be fun and they may be exciting and things change quickly and it's almost like gambling. But I personally think that you would be better off to ignore all of that nonsense and noise. And so I would avoid the investing apps. By the way, I've opened accounts with both just to try them out. I wouldn't recommend them. So there you go. It's pretty straightforward. And the great thing is, whatever you choose, if you have any questions about how to actually open the account and get started, they'll all answer them for you. Give them a call. I mean, I do that even now after 30 years of investing. When some question comes up, I give Vanguard or Fidelity a call, and they've all been great to work with. All right. So on the home stretch, now we need to figure out how much money we should invest. So when it comes to how much to invest, obviously that's a very personal question. It's going to depend on your goals, your income, and it's going to change over time. When I started investing, I think it was about $50 a month. It was all I could afford. And, that was a great way to get started. So obviously a personal question, but I do have sort of two observations. The first is, I've said it before, get the match. If you've got an employer that matches your contributions, you want to work hard to contribute. It's usually 6% of income, but whatever amount you need to take full advantage of the match. And let me just say, it's in part because of the match that when I hear folks say, no, 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 pay off all of your debt before you start investing one penny, I go crazy. That's like the worst advice ever, particularly if you're paying off like low rate student loan debt. That's just crazy town. So I think you know how I feel about this. Get the match. That's the number one priority. That's just free money. And over a lifetime of investing, the match, we're talking hundreds of thousands, if not more, because of a company match, if you happen to be lucky enough to have that during your entire career. So that's the number one thing. The second thing is think about long-term goals. So, and here I want to give you a resource. Let me pull it up. I'll put it right in the notes. And it's called Net Worthify. And if we go to it, it's a calculator about when you can retire. And what you can do is you can put obviously your income, how much you're saving, how much you're spending. It'll calculate your savings rate. You can also, if you already have some money saved, put in your current portfolio, and it will give you an estimate of how many years until you retire. Now, there's a lot of assumptions here, and you can actually view them all here, and then you can look at sort of a table of the results. I think this is a fun tool to use. Recognize that it's a high level, I might even call it guesstimate. I mean, it's based on actual numbers, but of course we don't know what the stock market's going to do, what the bond market's going to do. You don't know, how much you'll be able to save going forward. As I said, we don't normally save the exact amount, every year. Maybe we get some raises, maybe we can save a little more. Maybe some unexpected life events happen, we can save a little less. But this can give you at least an idea of how long it will take you to retire or perhaps achieve financial freedom, which to me, I roughly define as having saved and having your accounts 25 times your annual expenses. Again, that's just a rough guideline for financial freedom. But I think this retirement or this calculator is a good starting point. And then actually one other thing I would say on this topic is that think in percentages of income. What percentage of your income are you saving? That's how I think about it. So if someone says to me, I'm saving 10 grand a month even, or a year, whatever, that doesn't tell me much. If that's LeBron James, I'm like, you should probably be saving more than that. If it's a teacher, then maybe you're doing great, right? So it depends where you are. The real key is what percentage of your income are you saving? I think at an absolute bare minimum, you want to set 10% as your goal. You may not be there now, fine. I certainly wasn't when I got started. And you get a raise, you increase it a little bit more, maybe you can cut your expenses, you do the best you can. I think I would call this, I'll call it the short-term goal. Now that could still mean years to get there, but not decades. It would be what I would set it at. I would think of this as sort of the longer-term goal, depending on where you are. And then I would say 30% would be ideal. And I know if you're thinking, Rob, 30% is crazy. Yeah, I would have thought the same thing 25 years ago. But I think that is ideal. And, but I understand that not everyone's going to get there. Maybe not everyone wants to get there. You may have other financial priorities. I get it. And certainly you may want to buy a home. You want to save for your child's education. So I understand sort of long-term, either retirement or financial freedom investing is not your only goal. I get it. But if you can stretch to the 30% mark, you're going to build wealth incredibly fast. Again, I know that's not realistic for everyone, perhaps, but I would put it in the maybe the ideal category. So long video, I know. For those that have watched the whole thing, thank you. You're a real trooper. If you have questions, leave them in the comments below. I will do my best to help you out any way I can. Now, I promised that you would have access to this, and you will. And let's go to the, oh, here we go. So if we actually expand all of this, you can see that it's quite a lot of detail. And in fact, when I finish this video, I'm going to be adding some things to this, and actually will be adding to this over time. So this is only going to grow. So what I'll do is simply leave instructions in the description below on how you can access this. And it's on the web, so it'll just be a link. And hope it's helpful to you. Again, any questions about it, let me know. And that's it. So until next time, remember, the best thing money can buy is financial freedom.